All right, this is James, the Giant Economy. We're going to jump right into it. This is a very rainy day in Texas today. But we're going to talk about oil first and what happened because oil was hovering around like $74, $75. It did jump down to, it was like 67, 68 or something, and then now it's popped back up to about 71, 72, and it's kind of floating in this $70-ish mid-range, right? So what happens? Well, OPEC Plus had a meeting that they were expected to talk about production cuts, right? And OPEC Plus is a collection of companies, countries that all produce oil. And the market was expecting to say, hey, we're going to cut production by this much, as an aggregate. But two countries had issues with these production adjustments, right? And so if they basically what happened is if they're saying, hey, you can only produce 1 million barrels a day or something, and they're producing 900,000 a day, they're not meeting their current production cuts. And then OPEC says, or they decide, hey, everybody cuts, 500. Some of these countries are saying, hey, we're not making our current ones. Why are you making us cut down even more production when we can't make our current production levels, right? And so Angola and Nigeria had a little bit of squabble with that to lower their baseline or below what they're producing. And so basically OPEC Plus tabled it and said, hey, we're going to try and put this together, but we're not going to make any choices now. We're going to do it in our next meeting in the future, which is, I think, another month or two, something like that. So with that, oil, quote unquote, tanked a little bit. It went down, $5, $7 a barrel, something like that. And within a week, it popped back up, right? So what does that tell us with oil, right? Well, let's jump into our chart. So we saw back here in November 2022, oil was kind of in a down slump, right? Kind of bumping up and down. But the biggest thing and then it popped out of that in the summer of 23, this summer, came up, hit a high of about $95, $96, something like that. Came, and now it's on its way down. It could go down, but it's starting, my guess is it's going to start to buck the trend here, right? Or it's not going to I think once it dips below $70, or maybe 69, it starts to buck the trend as we've seen this week. It fell, I think, 67, maybe 66 for a portion of a day, and then it popped back up. As we can see on here, oil has a good line of resistance right here all the way back to August of 2021, right? 2.5 years ago almost, right? So it's going to take a lot to break this line of resistance. So I think the floor to oil is around $65 a barrel right now as we see it. It'll hit that floor, it'll tap that floor. Here it may go up, it may go down, tap the floor, and then start to pull up again, up into this 90 range, and then we'll see what happens there, right? Kind of 90 may become resistance, and the floor may be around 65, right? I would love it if it stayed between 85 and 90, maybe $100 a barrel. That would be great. I would love that, but I can't do the future. But that's where oil's at. Like, we still have the constraints. We still have fears of a recession coming and people using less oil. And I think recession is on its way. But at the same time, we've got the issue of there's not a lot of inventory with oil, and oil is something you have to use, right? You're not going to carpool to work. Housing, you can put a bunch of people into a bunch of rooms. You can have roommates. You can have shares. People do some crazy things in housing sometimes to make ends meet, right? When it comes to oil and energy, you're going to keep the lights on. You're going to keep your gas tank filled. You're going to keep using it, right? In fact, we're actually using more energy this year than we have ever in the past, right? The numbers for that just came out. Another thing I'll say about oil and gas is that natural gas prices are suffering because we are having a very warm winter. Last year was warm. So far this year has been quite warm, right? But once that changes, natural gas should pop up quite a bit. Okay, And we're going to go through the bottoms. All right, jobs numbers. Let's talk about that a little bit. So they came in um, a little bit over, but they're still a little bit stagnant. And you can read the reports and everything like. But there's some shopping, some with the I think it was Jolts report or something like that. It was kind of everywhere. People didn't know what to think. That's why I think earlier this month the stock market was a little shaky and then it popped back up, right? Employment numbers fall for November. Labor market remains moderate. So what we are seeing is employers start to get more picky with their hires and how many they hire and what positions they do really need that position to be filled because it's an expense. We're starting to see that come out, right? And all of that will come out in, here we go, we'll just do this one, in stagflation. This is, so my thoughts for, I'm going to go into my thoughts for 2024 here, right? We've covered oil. We're gonna talk about the Fed, their news, and what they're happening, but I'm going to jump forward a little bit. I think this next year, I think we're already in this partially. I think the beginning of 2024 is going to be stagflation, right? We've got a GDP that keeps floating down. It's floating down very slowly, but it's floating downward, right? Corporate earnings are going down, right? Not necessarily how much they produce, but how much they earn, right? Inflation is still relatively high, even though the Fed has in their minds, is winning the battle against inflation. It's not maybe not raging as much as it was, but it's still a forest fire, if that makes sense. And then unemployment is yet to come up. And so that is the real shoe that's going to drop. Unemployment has come up a little bit, right? I did a video on the Psalms report. You can see it on this channel. But unemployment did go up. It came down a little bit, but it's still heading towards. It's still in the channel that's heading towards not a good way. So we'll have to keep an eye on unemployment. Once unemployment goes up, that's when deflation really starts to hit. It's going to get kind of ugly, right? All right, so Fed news. Let's start with that. And we're just going to pop this chart up while we do that. So, I was listening to something and they made a really good point. Before 2008, right? Let's see here. Before 2007, 2008, the Great Recession, right? The Fed didn't really talk very much. Nobody really was really paying attention to them, right? They did speak a little bit here and there, but it wasn't really a big deal per se. Their words didn't carry as much weight as they do now, right? Then we had the recession, 2007, 2008. The Fed jumped in to backstop the market for quantitative easing and a lot of free money sent to everybody. And so now everyone, now everyone pays attention to the Fed because what they do, the ripples they make create waves down the line. And so the Fed just came out and said, hey, we are not going to, we think, it was very ambiguous, right? If you ask anybody, I've been to 3 real estate meetings this week so far, and I missed one tonight, but everybody in real estate is happy, is jumping up and down, or half of them are, being like, hey, the Fed said they're going to lower rates. Woohoo! Everything's going to go up. Housing just goes up. Everything just goes up. Rates just go up. And there's some of us like, well, they didn't say that they were going to lower rates. They said that they think they are done with raising rates. Though they do reserve the right to keep raising rates if they need to. And they gave an estimation of how much they would lower it to in total and how long it would take them to lower them. So I think next year they are estimating 3 rate cuts in 2024, 4 rate cuts in 2024 or 6, I forget, rate cuts in 2025, and then another 3 to 4 rate cuts in 2026, right? So altogether, they're going to have 10 to 12 rate cuts, and it's going to, if you do the math, it's going to put it down to anywhere from 2 to 2.25%. So that's their floor, right? Right now, it's around 5-ish or something like that, and that's why home rates are at 8. It's typically it's 3. That's 3% spread. So that means like when the Fed is done, the best interest rates we could see, if everything goes according to their plan, is around 5.25%, right? Uh, we're probably not going to see the 2 to 3% rates anymore. This isn't talking about price or anything, it's just talking about interest rates. And the Fed did say that they do reserve the right that if there is a recession, they would cut rates, faster and stronger, right? To help spur on the economy. Um, all this goes on to say that this is their plan. This is what they hope, the best case scenario, but they're not promising anything, right? So right now, you gotta. This is very hard. We're in, as people have said, unprecedented times, and an investor's worst worst thing, the one that gets you caught so much, is this time is different, right? This time is different from the last recession. This time is different from the last recession. And so, yeah, you got to make a decision on where you're at. Are we going to go into a pretty bad recession? Are we going to go into hyperinflation? Are we going to, what's going to happen? Because, when Jerome Powell came out and said that, what he did, the markets jumped up, right? Well, that makes everything more expensive. That kind of goes counterintuitive to what he's trying to do. Okay. And so, because if interest rates go down and people start rushing towards housing again, well, that's going to drive the prices back up, right? So, and I don't think he wants to have a double dip recession. He has said he does not want to repeat the mistakes of Paul Volcker. Not a double dip recession, but a double recession, or double inflation, excuse me. He doesn't want to do what Paul Volcker did and undo rates too early, and then you have another inflationary event and you have to clamp down rates again. So I think, this is my opinion, I think he's going to hold next year. I don't know if there's going to be a rate cut at all, or not until something starts to break. Now, we'll see what happens, but either way, you gotta position yourself in a way that helps with both of them, right? And that's why I'm in oil right now, because it is inflation protected, recession resistant, right? And so, and it's liability free. What I'm doing, like if the whole place burns down, I don't have to pay into my pocket. My assets just sit there. I don't have to pay a mortgage. I don't have to pay insurance. I don't have to pay for a roof, a toilet, maintenance or anything like that. So it's quite nice. But it's up to you. I'm just giving you information to make this on. But the last thing we're going to look at, and this is the one this is kind of the Buffett indicator, the yield curve inversion. This is a wonderful chart brought to us by longtermtrends.net. And this goes, I backed up all the way to the 80s, right? Because this could be something like the 80s. Let's look at where we're at today. So 2020, we bumped it a little bit. It was actually 2019, which a lot of people were talking about recession back then. And I'll tell you this right now, those issues have not gone away. They've just gotten worse. So it came up, and then all of a sudden, in 2022, it started to invert, and invert badly. This is one of the worst inversions we've had since the 80s, actually. Yeah, since the 80s. And now it came back up, and now it's going back down a little bit, right? So it could be like the 80s, where we just bump around here for a while, and then it comes out all of a sudden, and that's when we have a huge crash, right? Or have a crash. So the yield curve inversion is a good sign of when things are about to get bad. The reality is things don't get bad until the yield curve uninverts, and then the poop hits the fan, right? So here's a great example. 2006. This was when the Great Recession, the Great Recession was the flames were being lit, right? And it uninverts in 2007, and that's when you get your Great Recession, right? Dot-com bubble, 2000 November, December. I mean, almost right on the dot, December or January of 2020/2021. Bam! It inverts. Oh, and I just did something wrong. It inverts, and then everything goes a bit crazy. The 90s had a very small recession, right? The 80s this is the double dip recession, as it's called. So in other words, you had to fight inflation, you had to push things down, and then Volcker very shortly after lowered rates, and then everybody started spending again, and then inflation popped its head again. So that was double dip. I remember something very clear that someone said 80, 81 or 82 was a very, very bad year, right? And so that, I think that's when the peak of it really, really hit. So this is the yield curve. It's I think it's been wrong once in its history to calling recessions, but the choice is really yours. I just give this information out here. I think, in my personal opinion, 2024 is going to be a very rough year. It could the brown smelly stuff could hit the fan in Q1. I'm guessing sometime in Q2 or Q3. That's when we'll at least see it launching at the fan, but it may not hit the wall or whatever's behind it until tail end of Q3 or Q4, right? I'm expecting, I'm hoping on some good deals to come in end of 2024 or early 2025, right? So where I'm at right now, I've got my assets all locked in, everything's good. I'm just going to be holding cash, and from what those assets, the heavy cash flow those assets produce, I'm just going to be holding that and building relations, connections, people to take advantage of this market. So if that interests you, if you like that idea, or if you want to learn more, go ahead and contact me. My information is down below, and I'll see you in the next video.